On March 31, 2023, the Social Security Board of Trustees released a document that should have been the headline of every news station in America. It wasn't. It was buried. The document is the annual report of the Board of Trustees. If you turn to page 5, the government explicitly admits the date the system fails. The date is 2033. The report states that in 2033, the old age and survivors insurance, OASI Trust Fund will be depleted. At that moment, the law mandates an automatic, immediate cut to benefits. This is not a prediction by a conspiracy theorist. This is the official accounting of the United States government. According to their own math, if Congress does nothing, every single check sent to retirees, whether you are 65 or 95, will be cut by roughly 21% overnight. If you are expecting a $2,000 check to pay your rent and buy medicine, you will receive $1.580. The rent doesn't go down. The medicine price doesn't go down. But your income disappears. Most Americans believe Social Security is a savings account. They believe that for 40 years, the government took money out of their paycheck and put it into a vault with their name on it. This video is an explanation of why that is mathematically false. We are going to look at the pay as you go structure, the truth about the trust fund, IOUs, and the demographic collapse that makes saving the system mathematically impossible. The system isn't going broke. It is broken. And 2033 is simply the year the accounting tricks stop working. A 200-500 the meaty in a semi-he ein VRPYAMI to understand why the collapse is inevitable. You have to look at the worker to beneficiary ratio. Social Security is not a funded pension system. In a real pension, you invest money, it grows, and you draw from the principal and interest. Social Security is a transfer payment system. The money taken from your check on Friday is not saved. It is transferred immediately to a retiree on Monday. The money comes in one door and goes out the other. This system relies entirely on demographics. You need a massive base of young workers to support a small tip of retirees. Let's look at the data in 1945. There were 41.9 workers paying taxes for every one retiree collecting benefits. The burden was microscopic. The system was flush with cash. By 1960, that number dropped to 5.1 workers per retiree. Still healthy. 5 people splitting the bill for one person is sustainable. Today, in 2025, the ratio has collapsed to 2.7 workers per retiree. And as the baby boomers, the largest generation in history, continue to retire, and birth rates continue to fall, that ratio is heading toward 2.3. This is the inverted pyramid. When you have only 2 workers trying to support themselves, their families, and 1 full retiree, the tax rate required to sustain the system becomes mathematically impossible. If you wanted to keep paying retirees 100% of their promised benefits, you would have to raise payroll taxes on young workers to levels that would crash the economy. You cannot tax a shrinking workforce enough to pay for a growing elderly population. This is why economists call it a Ponzi scheme. In a Ponzi scheme, the early investors get paid by the new investors. The scheme collapses when you run out of new investors. Because of the birth rate collapse, which we will discuss later, the United States has run out of new investors. But you will hear politicians say, don't worry about the ratio.
We have the trust fund.
We have $2.8 trillion saved up in surplus. This is the single biggest lie in American finance. We need to explain exactly what is inside the Social Security Trust Fund. If you drive to Parkersburg, West Virginia, there is a filing cabinet maintained by the Bureau of the Public Debt. Inside that cabinet are the assets of the Social Security Trust Fund. There is no cash. There are no stocks. There is no gold. There is no real estate. The only thing in that cabinet is special issue government series, bonds. Here is how the scam works. For 30 years, Social Security collected more in taxes than it paid out, at the baby boomer surplus. By law, Social Security is required to invest that surplus in U.S. Treasury debt. So, Social Security handed the cash to the U.S. Treasury, the General Fund. The General Fund took that cash and spent it immediately. They spent it on wars in the Middle East, welfare programs, and infrastructure. The money is gone. In exchange, the Treasury wrote a piece of paper, an IOU, and gave it to Social Security. The trust fund is essentially a collection of IOUs that the government wrote to itself. Imagine you take 100 out of your savings account to buy groceries. You write a note on a napkin that says, "I owe myself 100, and you put the napkin in the safe. Do you have 100 in the safe? No, you have a napkin. The only way to get the 100 back is to earn new money in the future. This is the crisis of 2033. Until recently, Social Security tax revenue was enough to pay the benefits. But starting around 2021, the cost of benefits exceeded the tax revenue. We are now in a deficit. To pay the retirees today, Social Security has to go to that filing cabinet in West Virginia, take out a bond, and ask the Treasury to cash it. But remember, the Treasury spent the money. The Treasury is dare $36 trillion in debt. So, to pay back Social Security, the Treasury has to do one of two things: raise income taxes on the general public. Borrow more money from the public, else issue new debt. This means the trust fund provides no net economic value. To pay you your own money, the government has to tax you again or print the money. Why is this happening now? Why is 2033 the deadline? It comes down to one number: 2.1. The replacement rate is the number of children a woman needs to have to keep a population stable. That number is 2.1 children per woman. If a country stays above 2.1, its tax base grows and Social Security works. If a country falls below 2.1, its tax base shrinks, and the liabilities crush the young. The United States has fallen off a cliff. The U.S. birth rate is now approximately 1.6. We are shrinking. This is creating a top-heavy society. By 2034, for the first time in U.S. history, there will be more seniors over the age of 65 than children under the age of 18. Think about the economic implications of that. Seniors are deflationary producers, but inflationary consumers of healthcare. They draw from the system. Children are the future tax base. We are entering a death spiral where the cost of care, Medicare and Social Security, is exploding at the exact moment the engine of growth, the workforce, is stalling. We are following the exact path of Japan, but with one major difference: Japan has a high savings rate. The average American has almost zero savings and relies entirely on Social Security for survival. So, what happens in 2033? Why can't the government just borrow the money to keep paying the full benefits? This is the legal trap most people don't know about. Social Security has a unique legal status. It does not have borrowing authority. The Department of Defense can borrow money. The rest of the government can run a deficit. But under the Social Security Act and the Anti-Deficiency Act, the Social Security Administration is legally prohibited from spending money it does not have in its trust fund. When the trust fund balance hits the reserve projected for 2033, the agency loses the legal authority to write checks for the full amount. They are legally required to look at the incoming tax revenue, which will only cover about 79% of the costs, and immediately reduce the outgoing checks to match that number. There is no phase in. It is a cliff. Of course, politicians will try to fix it. But look at their options: raise the retirement age. They will likely push it to 70 or 72. This is a benefit cut by another name. You pay in for longer and die sooner. Raise the tax cap. Currently, you only pay Social Security tax on the first $160,000 of income. They will uncap this. But this is a massive tax hike on the middle class and upper class that will drag down the economy. Means testing: they will tell you that if you have a 401k or savings, you don't get a check. This turns Social Security from a pension into welfare, breaking the social contract completely. There is one final option, and it is the most likely one. It is the soft default. Congress could change the law to allow the Federal Reserve to simply print the difference. They could monetize the debt. If they do this, you will receive your full check. The check will say 2,000, but because they had to print trillions of dollars to fund those checks, the inflation rate will skyrocket. They will use metrics like chained CPI to undercalculate the cost of living adjustment, COLA. If real inflation is 8%, they will say it is 3% and give you a 3% raise. Every year, your purchasing power will bleed away. You will get the paper bills you were promised, but they will not buy the food you need. The year 2033 is not a theory. It is a mathematical wall. The trust fund is a file cabinet of IOUs. The demographics are in terminal decline. The worker-to-retiree ratio has collapsed. The takeaway is simple: do not plan on Social Security. If you are under the age of 50, you must view that line item on your paycheck not as a contribution to your future, but as a tax for the present. The insolvency is already here. 2033 is just the year the rest of the world finds out.